Should you invest in a traditional IPO or a SPAC IPO? Now, SPAC SPAC stands for Special Purpose Acquisition Company. I recommend sticking with a traditional IPO instead of a SPAC if you can, as the risks are much, much lower with a traditional IPO, and here is why. A traditional IPO contains a massive legal document called an S-1, which we can use to read all about the risks, the financial statements, and the business model in much more detail. And these massive S-1 documents are written by investment bankers, written by investment bankers and lawyers, because this is a regulated market and governments want to ensure that investors don't get scammed. So what we'll do now is we'll go quickly together to sec.gov and we'll enter in the ticker FB for Facebook so we can access Facebook's IPO document. Now this is for a traditional IPO, not for a SPAC. And we will go to sec.gov. That's the Securities and Exchange Commission's website. And we'll go to company filings, okay? And by law, all companies going public with a traditional IPO have to disclose all risks. So we'll type in FB for Facebook. Okay, great. And let's go here to, Facebook search. All right, more options. I'm gonna type in the ticker. Give me 1 second, guys, sorry. And they just changed this website as well. So it's a little bit difficult for this 50-year-old man-child here to navigate. Here we go. Okay, great. All right, so this here is for Facebook. Then what we do is we type in S1, okay? This is the document that everyone has to file when they go public with a traditional IPO. And so here's the S1 document. When you see the letter A beside it, what that means is the IPO document was amended, okay? So back in 2012 when Facebook went public, the bankers filed this document. And this document here contains everything you need to know about an IPO, okay? And these documents are not as big or as thorough if you do a SPAC IPO. A traditional one, they exist, of course. So if we scroll down here through this investment banking S1 prospectus, we could see Morgan Stanley led the deal, top left, and Goldman was top right, okay? And these two here compete aggressively against each other. They're like the Boston Red Sox and the New York Yankees, right? There's good competition involved with IPOs. You could scroll down through here and read everything you need to know about the company, the management team, etc. If you do a search for the word risk, there's 72 instances of it, right? So you can read all about the risks here if you want to. Now, when it comes to SPACs, SPAC IPOs, the company does not have to disclose as much information in their version of what's called the S1 filing. Also, a company often chooses to do a SPAC IPO because it's a lot cheaper for the company and they can go public faster, which is not a good thing. It's not a good thing for investors because with a traditional IPO, the investment bankers and lawyers do a lot more due diligence on the company going public, and they disclose all of the material risks by law to investors in the S1 filing, similar to the Facebook IPO S1 filing that we just looked at together. And in a traditional IPO, the investment bankers have their management team of the company going public meet with many investors. And the management team often gives the shares of the IPO to the investors that understand the company the best, which means that hopefully they're less likely to flip the deal, the investors, and sell it on day one of the IPO. Now, that process I just explained is called an investment banking roadshow. And SPAC IPOs don't use elaborate roadshows, which means the investors in a SPAC IPO might just be tourists renting the stock, meaning they're more likely to sell the stock, leading the price, making the price of the IPO go down. Okay, and with SPAC, there's not nearly as many government regulations, which means it's riskier. So on a regulatory spectrum here, we have a traditional IPO all the way on the right side. Okay, this is regulated by the government. On the left side of the risk spectrum here, we have no regulation, meaning very risky. And this is what we see with cryptocurrencies when they go public, when they IPO, which is called an ICO, meaning an initial coin offering. And ICOs are risky because cryptocurrencies are not regulated by governments, but instead, the good cryptocurrencies are regulated by the laws of mathematics when it comes to the maximum number of cryptos that can be mined. So I place SPAC IPOs in the middle here because, yes, they do offer some sort of investment offering memorandum that you can read, but certainly not as detailed as a traditional IPO's S1 filing. If we add the element of time to our spectrum here for an ICO or an IPO, on the right side you can see it takes 12 to 18 months for a traditional IPO to occur. It takes 6 to 12 months to do a SPAC IPO, and an ICO, all the way on the left side there, is well under 6 months. And so I don't recommend ever investing in any company, public or private, unless you can read a very detailed investment offering, like an S1 prepared by lawyers. And if you have a friend that asks you to invest in their company, what I want you to do is I want you to ask them for the investment offering legal document so you can look at all the risks. And then quietly ask yourself, why am I so lucky to be given this opportunity to invest in my friend's company? And this following thing I'm going to say, I say it with love in my heart. It might be because nobody else wants to invest. So the bottom line is, before investing in anything, always please read the investment offering memorandum like the S1 document. And until SPAC IPOs are more regulated, I prefer the traditional IPO. Now, if this was useful, please like, comment, and subscribe, and thank you.